Every single bank on earth is running the exact same play on you, and almost nobody ever stops to notice it. You put your money in, they pay you next to nothing for the privilege of holding it, then they turn around and lend that same money back out, sometimes to a stranger, sometimes to a business, sometimes back to you in the form of a loan you pay interest on, at a rate multiple times higher than what they paid you for it. That gap, that space between what they pay you and what they charge everyone else has a name. It's called the spread. And for the entire span of your financial life, you have been on the wrong side of it. Here's what almost nobody tells you. That spread isn't a law of physics. It's a structure. And structures can be rebuilt, owned, and redirected by you for your own family. Starting now. I'm Dr. Ben, and this is Wealth Forge. We don't follow the market, we design the moat. In a world of followers, we are the architects of our own freedom. Today, we're not talking about beating the market or timing the next big move. We're talking about something quieter and, frankly, more powerful. Building a private banking function inside your own family, one that captures the spread instead of paying it, and that compounds across generations instead of resetting every time a paycheck lands and disappears. By the end of this, you'll understand exactly how private family banking works, why the wealthiest families in the world have quietly run their finances this way for over a century, and how to start building your own version of it, even if you're starting from nothing but a paycheck and a plan. Let's start with the illusion you've been living inside without ever questioning it. You think of a bank as a place, a building, an app, a login screen. But a bank isn't a place. A bank is a function. The function of storing capital, controlling access to that capital, and profiting from every single transaction that flows through it. Right now, in your financial life, that function belongs entirely to institutions you don't own, didn't build, and don't control. Your emergency fund sits in an account earning a fraction of a percent, while the bank turns around and lends that exact same pool of money out at credit card rates, auto loan rates, mortgage rates. You financed your car through a bank and paid interest on it. You put money in a savings account, and the bank paid you almost nothing to use it. Every dollar you've ever saved has at some point generated profit, just never for you. This is the part that should genuinely bother you once you see it clearly. It's not that banks are doing something illegal or even unusual. They're doing exactly what banks are designed to do. The problem isn't the existence of the banking function. The problem is that you've spent your entire financial life renting access to a function you could, with the right structure, own outright. Play this out with numbers you'll recognize from your own life. You finance a vehicle for $35,000 over 6 years. By the time that loan is paid off, you've handed the lender several $1,000s in interest, money that simply vanished from your life and appeared in a bank's earnings report. Meanwhile, the emergency fund you kept sitting in savings that same year earned you a return so small it barely covered a single tank of gas. Two completely separate transactions, two completely separate accounts, and yet both of them quietly transferred value away from you and toward an institution that did nothing but sit in the middle. That's not a single unlucky year. That's the default operating condition of a financial life built entirely around institutions you don't own. Now multiply that pattern across a full lifetime, a mortgage, multiple vehicles, a business loan or two, credit used for emergencies, home repairs, unexpected expenses. Every single one of those transactions carried the same hidden structure, you paying interest in one direction while your own idle capital earned close to nothing in the other. Nobody ever sits you down and shows you that pattern as a single connected system because no institution profiting from it has any reason to. So why does almost nobody build their own version of this? Because most financial advice keeps you focused entirely on one side of the equation, how to invest, how to save, how to budget, and never once ask the more fundamental question, who controls the capital and who profits from the movement of it? You've been trained to think like a depositor. Today, we're going to think like a bank. Let's get specific about the mechanics, because once you understand exactly how a commercial bank captures the spread, you'll see precisely how a private family structure replicates it. A traditional bank operates on 3 pillars. First, it pools capital from depositors, paying them a low, often negligible rate of return in exchange for the use of their money. Second, it lends that pooled capital back out at a significantly higher rate to borrowers who need access to capital for a car, a home, a business, and an emergency. And third, and this is the part almost nobody thinks about, the original capital never actually leaves the bank's control. The depositor's balance stays intact on paper, growing at its slow, contracted rate, while the same same dollars are simultaneously working elsewhere, generating a completely separate stream of profit for the institution. That's the entire model. Uninterrupted compounding on one side, active lending profit on the other, running in parallel off the exact same base of capital. Now here's the reframe that changes everything. That three-pillar structure isn't exclusive to chartered banks. It's a pattern, and patterns can be rebuilt privately inside a family using tools that already exist and have existed for over 100 years. The vehicle most private banking structures are built around is a specially designed dividend-paying whole life insurance policy. Not the kind sold as a cheap add-on, but one deliberately structured to maximize early cash value growth. Here's why this specific tool matters. Inside a properly designed policy, your cash value grows on a contractual, guaranteed schedule, completely insulated from market volatility. That's pillar one, capital that compounds uninterrupted, regardless of what's happening anywhere else in your financial life. Now here's the mechanism that makes this genuinely powerful, the part most people never learn because nobody profits from teaching it to them. You can borrow against that cash value at essentially any time for essentially any purpose, without liquidating the underlying asset, and without the growth of that asset ever pausing while the loan is outstanding. Your capital keeps compounding on its full, uninterrupted balance while you simultaneously have access to it as usable liquid capital elsewhere. That's pillar two, active deployment of the same base of capital without stopping pillar one. Sit with that for a second, because this is the exact mechanism banks have used against you your entire life, now working in your favor instead. You're no longer choosing between my money grows and my money is accessible. You get both at the same time off the same dollars, which is precisely the structural advantage that has made banks extraordinarily profitable for centuries, now rebuilt at the scale of a single family.
I also want to address the criticism you may have already heard elsewhere, that permanent life insurance is a poor investment compared to simply investing in the market directly. That criticism isn't entirely wrong, and it isn't entirely right either, because it's answering a different question than the one we're actually asking. If you're evaluating this purely as an investment return competing against the stock market, you're comparing it to the wrong category from the start. This isn't meant to replace your investment portfolio. It's meant to sit alongside it as the stable, liquid, uninterrupted foundation that lets the rest of your portfolio take on real growth-oriented risk without you ever being forced to sell those investments at the wrong moment just because you needed cash. The families who use this well aren't choosing between the market and a policy. They're using the policy to fund the market entries and family needs that would otherwise have forced a bad sale at a bad time, while the growth-oriented capital keeps compounding untouched wherever it lives. I want to address the objection that's probably forming in your mind right now, because I hear it constantly and it deserves a direct answer rather than a dismissal. This sounds like something only wealthy families can do. That belief is exactly backwards, and it's worth understanding why. This structure isn't reserved for people who already have millions sitting in a portfolio somewhere. It's built through consistent, disciplined funding over time, the same discipline you'd otherwise apply to any savings or investment strategy, just redirected into a vehicle that lets you use the capital while it grows, instead of choosing between growth and access. Families who build this successfully aren't starting from extraordinary wealth. They're starting from ordinary income and extraordinary consistency, which is a completely different requirement and one that's available to far more people than the mainstream narrative around private banking would have you believe. This is exactly the moment a follower and an architect start making different decisions. A follower hears insurance and files it under boring, or worse, unnecessary, something to avoid rather than something to build with. An architect asks a different question entirely. What tool lets me control my own capital on my own terms without asking anyone's permission? That question is what separates a rented financial life from an owned one. Let's walk through what actually happens when you deploy this structure, because the mechanics matter more than the theory. Say you've built meaningful cash value inside your policy over several years of consistent funding. A need or an opportunity arises. A down payment, a piece of equipment for a business, a real estate deal, even an emergency expense that would otherwise force you into a high-interest personal loan. Instead of liquidating an investment, instead of applying to a bank and waiting on approval, instead of paying a stranger's institution interest on a loan collateralized by nothing but your credit score, you borrow against your own policy. The insurance company advances you the funds using your cash value as collateral. Your cash value itself is untouched and continues compounding at its full contracted rate, completely unaffected by the outstanding loan. You repay that loan on whatever schedule you set at a rate you control the terms of, and the interest you do pay, instead of vanishing into a bank's earnings report, flows back toward your own structure, your own family's capital base, rather than someone else's balance sheet. This is the entire spread recaptured. You are no longer the depositor earning a fraction of a percent while a stranger lends your money out for profit. You are the depositor and the lender simultaneously, inside a structure you built and control. Now let's zoom out from a single loan to the actual architecture of a private family bank, because the real power here isn't a single transaction, it's the system. The foundational move is establishing the policy itself, properly designed, properly funded, with a licensed professional who understands the specific structuring required to maximize early cash value rather than early death benefit, since those are two very different design priorities, and most agents default to the wrong one. Once that foundation exists and has time to build meaningful cash value, the structure starts to function less like a single financial product and more like a private capital reserve, one you can borrow against for real estate, for business capital, for major purchases you'd otherwise finance through a bank, for opportunities that require fast, flexible access to capital without anyone else's approval process standing between you and the decision. Here's where it becomes generational rather than personal. As the structure matures, additional policies can be layered on yourself, on your spouse, eventually on your children, each one becoming its own compounding reserve of family capital. The family collectively begins operating its own internal lending system. A child needs capital for their first business, or their first home, or their education. Instead of that capital flowing out to an external bank as interest paid to strangers, it flows through a family loan structure with clear terms, clear repayment, and the spread staying inside the family circulatory system instead of leaking out to an institution with zero connection to your family's future. This is the actual definition of generational wealth that almost nobody uses correctly. Generational wealth isn't simply leaving money behind when you die. It's building a functioning system that keeps capital circulating, growing, and available across generations so that every subsequent generation inherits not just an asset, but a working financial infrastructure, a bank in every functional sense that belongs to your family instead of a shareholder somewhere else. What does that governance actually look like in practice? It's simpler than most people assume once the foundation exists. A family loan follows the same basic shape as any bank loan: a clear amount, a clear interest rate, a clear repayment schedule, documented in writing rather than left as a vague verbal understanding that erodes trust the moment life gets complicated. The difference is that every term on that agreement is one your family decided together, rather than one dictated by an institution with no stake in your family's outcome. A daughter borrowing capital for her first home pays interest back into the family structure instead of a mortgage company. A son funding his first business round pays the family bank instead of a commercial lender charging whatever the market will bear. The capital never actually leaves the family. It just moves from one branch of it to another, growing the shared reserve every time it circulates. Some of the families I've worked with go a step further and formalize this into an actual family charter, a short, plainly written document that lays out how the structure works, who has access to it, how decisions about larger loans get made, and how the next generation gets introduced to it as they come of age. It doesn't need to be complicated or heavily legal. It needs to exist somewhere other than one person's memory, so the system survives the specific individual who first understood it, and so every generation after the first one inherits clarity instead of confusion about how their own family's capital actually works. Let's talk about why almost nobody builds this, because the obstacles aren't financial, they're structural blindness. Most people never encounter this concept because the entire mainstream financial industry is built around products that generate ongoing fees for the institution selling them: managed funds, brokerage accounts, retail banking products. None of those institutions have any incentive to teach you a structure that reduces your dependency on them. The information isn't hidden because it's complicated. It's hidden because it's not profitable for anyone else to teach you. There's also a character trait embedded in this vehicle that deserves its own moment because it's part of why the structure has survived unchanged for over a century, while flashier strategies come and go. The growth inside a properly designed policy is contractually guaranteed and shielded from market volatility, which means it behaves completely differently than the assets most people are used to thinking about. It doesn't crash when the broader market crashes. It doesn't pause when a recession hits. While the rest of your net worth might be fluctuating with headlines and interest rate decisions, this piece of your financial structure keeps compounding on its own predictable schedule, unaffected by any of it. That stability is precisely what makes it a foundation rather than a speculation, the bedrock you build the rest of your financial life on top of, not the exciting part of the portfolio, but the part that lets everything else you do carry more risk safely because you know this piece isn't going anywhere. The families who have used this approach for generations, and there are well-documented examples of prominent families and even historical industrialists structuring exactly this kind of internal banking system, didn't stumble into it. They deliberately built financial infrastructure instead of simply accumulating assets, understanding a distinction most people never draw. An asset sitting passively is not the same thing as a system actively compounding and actively available. A brokerage account is an asset. A family bank is infrastructure. Infrastructure serves you continuously. An asset just sits there until you decide to touch it. And touching it usually means selling it, taxing it, and losing the compounding you'd already built. So the question stops being whether a structure like this exists and works. It clearly does, and it has for well over a century. The only real question left is whether your family is going to keep renting capital access from institutions indefinitely, or start building the infrastructure that lets you own that function outright. This is exactly the gap I built my private family banking framework to close. Over the past several months, I've put together a complete blueprint that walks you through the entire process, start to finish. How to identify and work with the right kind of professional to design a policy correctly, since most agents will structure this incorrectly if you don't know the specific language to use with them. How to calculate the right funding level for your specific financial situation so you're building meaningful cash value without overextending your monthly capacity. How to structure your first policy loan the right way so you're using the mechanism as intended rather than accidentally undermining it. And how to layer additional policies over time so what starts as a single structure eventually becomes a genuine family banking system spanning multiple generations. I built this framework because I watched too many people hear the concept, get excited about it in the abstract, and then either implement it incorrectly with the wrong kind of policy or never implement it at all because nobody laid out the actual sequence of decisions in order. The difference between a family that successfully builds this and a family that doesn't isn't intelligence or income. It's having an actual blueprint instead of a vague idea. What makes this different from just watching a handful of videos on the topic and trying to piece it together yourself is the sequencing. Almost everyone who fails at implementing this strategy fails not because the concept is wrong, but because they did the steps out of order. Funding a policy before understanding the mechanics, working with the wrong professional because they didn't know what questions to ask, or taking your first policy loan for the wrong purpose before the structure had time to mature. The blueprint exists specifically to prevent those ordering mistakes, because in a strategy built on decades of compounding, an early misstep doesn't just cost you time, it costs you the entire trajectory of everything else that would have compounded on top of it. Let's talk about what actually building this looks like in practice, because I want you to leave here with more than just the concept. I want you to leave with the sequence. The first move is education before implementation. Before you fund a single dollar into a policy, you need to understand exactly how cash value growth works, how policy loans function, and how to distinguish a properly designed policy from a poorly designed one, because this single distinction determines whether the entire structure performs the way it's supposed to, or underperforms for the next several decades. This isn't a decision to make quickly or casually. It's infrastructure. You build infrastructure carefully, once, and you live with the consequences of that design for a very long time. Rushing this stage is the single most expensive mistake available to you, because a poorly designed policy is difficult and costly to unwind once it's in place, while a few extra weeks of genuine understanding costs you nothing but patience. The second move is finding the right professional to execute the design. Not every insurance agent understands infinite banking style structuring. Most default to conventional policy design optimized for death benefit rather than cash value access, which completely defeats the purpose of what we're building here. This distinction matters enormously. A conventional policy and a properly structured private banking policy can look nearly identical on the surface while performing completely differently in practice because the underlying ratios, riders, and funding schedule are configured for entirely different goals. Part of what I walk you through inside the framework is exactly what language to use, exactly what questions to ask, and exactly what red flags indicate you're talking to someone who doesn't understand the structure you're trying to build. The third move is funding consistently and patiently. Cash value in a properly designed policy builds meaningfully over the first several years, and understanding that timeline up front prevents the single most common mistake people make with this strategy, expecting immediate liquidity and abandoning the structure before it had time to mature into something genuinely useful. This is not a get-rich-quick mechanism.
It is patient infrastructure, built the same way any meaningful piece of infrastructure gets built. Steadily, with a long time horizon, and with full understanding of what you're constructing and why. The fourth move is your first deployment, taking your first policy loan for a real purpose, whether that's an investment opportunity, a piece of real estate, or capital for a business, and experiencing directly what it feels like to access your own capital without asking anyone's permission and without interrupting your own compounding. This is the moment the concept stops being theoretical and becomes something you've actually lived through, and it's the moment most people describe as the one that permanently changes how they think about where their money should live. There's a specific feeling that comes from requesting your own capital instead of applying for someone else's. No credit check, no approval committee, no waiting to find out whether a stranger considers you worthy of your own money. You already own it. You're simply choosing to use it. The fifth move, and the one that turns this from a personal strategy into an actual family legacy, is bringing the rest of your family into the structure. This means having the conversation with a spouse, eventually with children, about what a family bank is, how it works, and how future generations will interact with it. Establishing not just the financial infrastructure, but the family governance around it, so the system outlives any single person's involvement and becomes something the next generation inherits as a fully functional capital engine, rather than a complicated asset they don't understand and don't know how to use. This conversation matters more than people expect. A structure nobody else in the family understands is a structure that dies with the person who built it. A structure that next generation was raised inside, watched work, and understands the mechanics of is a structure that survives and compounds for another 50 years, past the point you're no longer the one managing it. I want to be honest with you about something, because architects deserve honesty instead of hype. This structure is not a shortcut, and it's not a secret trick that replaces the fundamentals of earning, saving, and investing wisely. It's a piece of infrastructure that changes where the spread goes once you're already doing those fundamentals well. If you have no consistent income and no capacity to fund a policy, this isn't your first move. Building your income and your baseline financial stability comes first, always. But once you have consistent cash flow and you're already saving, this structure determines whether that saved capital sits passively, earning almost nothing, while a bank profits from lending it elsewhere, or whether it becomes the foundation of a system you own and control for the rest of your life and beyond it. I also want to be honest about the early years, because this is where most people who abandon the strategy do so unnecessarily. A newly funded policy does not behave the same way in year 1 as it does in year 10. The early period is where the structure is being built, where the foundation is poured, not where the building is finished. Judging the strategy by its first 18 months is like judging a commercial building by what it looks like when the foundation is still being poured. The people who benefit most from this structure are the ones who understood that timeline going in, funded consistently regardless of short-term impatience, and let the compounding do what compounding always does when it's given enough time and isn't interrupted. There's a deeper shift happening here that goes beyond the mechanics, and it's worth naming directly.
Once you build this structure, your entire relationship with debt changes. Debt, for most people, is something that happens to them. A car loan they had no alternative to, a mortgage structured entirely on the bank's terms, a personal loan taken out of necessity at whatever rate they were offered. Inside a private family banking structure, debt becomes something you originate on your own terms to yourself, with the interest flowing back into your own capital base instead of out to a stranger. That's not a small distinction. That's the entire distinction between being a customer of the financial system and being an operator inside it. Think about what that means over a full lifetime and then over multiple lifetimes. Every major purchase you'd normally finance through a bank, a vehicle, a piece of real estate, a business expansion, instead flows through your own structure with the interest that would have left your family forever, instead staying inside it, compounding, available for the next need, the next opportunity, the next generation. Multiply that across every major financial decision across an entire family's multi-decade timeline, and you start to understand why families who build this kind of infrastructure early tend to compound wealth at a completely different rate than families who simply save and spend through conventional institutions their entire lives. It's not that they earned more, it's that they stopped leaking the spread to someone else's balance sheet decade after decade after generation. Picture the concrete version of this across a single family's next 20 years. A first policy loan funds a down payment on a rental property, and the rental income services both the mortgage on the property and the policy loan simultaneously, while the cash value underneath it all keeps compounding, untouched. A second policy, open for a child, quietly builds for 15 years before that child ever needs it, then becomes the seed capital for their first business instead of a bank loan they'd have spent years qualifying for. A third policy, structured specifically for eventual estate transfer, passes capital to the next generation with none of the delay or erosion that typically comes with probate and conventional inheritance. None of these are separate strategies. They're the same infrastructure applied 3 different ways, all feeding the same family reserve. This is what it looks like when a family stops treating each financial decision as an isolated event and starts treating their capital as a single connected system. This is what it actually means to design the moat instead of just trying to win inside someone else's system. A moat isn't a bigger paycheck or a better investment pick. A moat is infrastructure that protects and compounds what you've already built, regardless of what's happening in the broader market, regardless of interest rate cycles, regardless of which direction the economy is moving in any given year. While everyone else is checking their portfolio and hoping the market cooperates, a family with this structure in place has a private, contractually guaranteed capital reserve, compounding quietly in the background, available on their terms, completely insulated from the noise everyone else is reacting to. Compare the 2 postures directly, because this is really the entire choice in front of you. A follower's life is a series of reactions. React to interest rate announcements, react to market downturns, react to whatever a bank decides to offer or deny them in any given year, always responding to terms someone else set.
An architect's financial life is a series of decisions made from a position of control, deciding when to deploy capital, deciding the terms of their own lending, deciding what gets built next on a foundation that doesn't move just because a headline changed. That's not a difference in wealth, that's a difference in posture, and it's available to you starting with the very first policy you fund. Hit subscribe if you're ready to stop renting the banking function from institutions that have zero loyalty to your family's future and start building the private infrastructure that keeps the spread inside your own bloodline instead of someone else's shareholder report. The doors to the private family banking blueprint are open right now, and I'll walk you through exactly how to get started in the link below. Go back to where we started. Every bank on earth profits from the gap between what it pays you and what it charges everyone else. That gap has a name, and starting today, you have the option of owning it instead of paying it. We're not here to follow the shift everyone else has been sleepwalking through their entire financial life. We're here to design the structure that sits underneath it. That's what it means to be an architect. Build your bank, own your spread, pass it down. And once this structure is running inside your family, the next conversation is about what happens when the wealth inside it starts crossing borders. How the same families running private banking structures are also thinking about where that capital legally lives, which jurisdictions offer the strongest protection, and why jurisdiction is about to matter more than almost anything else on this channel going forward. I'll see you